So you see, this presentation was held just 1 month ago in Frankfurt in our corporate finance class. And we had two visitors, Daniel Fischer and Giovanna Mack. And you see how international they are. Giovanna is an Italian first name. And they came from two private equity funds and basically presented how it is to work in a private equity fund. If you just go by salary, the richest people that I know are all successful private equity managers. A friend of mine, a close friend of mine, just has worked for 10 years in private equity and became a multi-millionaire. So if you really want to become rich, and if you want to have an exciting life, private equity is much better than investment banking nowadays. But all my students, of course, ask me, how can I get into these funds? And the answer is almost always, we only hire experienced industry professionals. So my friend was a banker for a long period of time and then went into private equity. Some people start with consulting at McKinsey and then become private equity. This is nothing where you recruit students. So it was a special honor that they came to university, because they clearly did not come because they were interested in our students, and they wanted to explain what private equity actually is. And they basically introduced the two funds, Montagu and Alpha, private equity funds, and then they explained how do we invest and then how do we make money. Then they also has a case study. We don't go through the whole of the presentation, but the most important parts. So Montagu is basically a fund that has been founded 50 years ago. They say we have a proven investment strategy. So basically, what they do is very simple. They buy a company, and then 3 to 5 years later, they sell the company again. And in between, they try to increase the value. And the investment strategy is basically the receipts and the tricks and the experience how to improve the value of the company in a rather short period of time. Usually 3 to 5 years. And they are institutionalized, means they have many people. Everybody knows exactly what he has to do. It's not just one person like Elon Musk who basically identifies a company and buys it. It's a team. And they have a European focus, and in particular a Northern European focus. So they come from the UK and focus on the northern part. So Italy is not what they like to. 75% UK companies, that's where they come from. And then France and DACH is basically an abbreviation for D stands for Deutschland, Germany, A stands for Austria, and CH stands for Switzerland. So DACH is basically the German-speaking countries. In Germany and Austria and in Switzerland, German is the predominant language. And they have 16 nationalities. People from many, many different countries, and they work in 5 offices. The biggest is in London, and they also have an office in Frankfurt. But it's a small company. I think they have no more than 30 or 40 employees. So don't think this is like a bank. It's very small. They know each other very well. And they focus on the mid-market. So the companies that they buy have something like smaller than 500 million in enterprise value. This is rather small. Haribo, for example, is way too big for that. They have a large target universe. That simply means we don't focus on one industry or on one country. And then therefore they diversify. Many of these funds are highly focused. They basically say we only know digital business models, and we only want to buy tech companies or this kind of things. They don't do so. But they focus on primary buyouts. And primary, they focus on buyouts. And there were many buyouts, and then they focus on primary buyouts. So a buyout is nothing else than a short word for a leveraged buyout. And a leveraged buyout is a takeover of a company, which uses much leverage. And primary means it is the first time. So this is like Haribo. It used to be a family-owned company. Then maybe the owner becomes old, yeah, at the age of 70, he decides to sell his company. Yeah? This is the first and therefore primary buyout. Yeah? Then Montagu buys this, and after 5 years they sell this. Yeah? If they don't sell it to the stock market as an IPO, if they don't sell it to another family like Heidelberg, but if they sell it to a second private equity fund, yeah, then we call this a secondary buyout. And many, many transactions are today secondary buyouts. Yeah? You buy from other funds. Yeah? And the reason is these people are forced to sell after 5 years. Yeah? They have a contract charter. Basically, they promise to investors, you invest your money, and after 5 years, on average, you will see your money back. Yeah? And 10 years, of course, the absolute latest. Yeah? They promise to the investors, yeah, after 10 years, the fund will be dissolved, and all the money is turned back. Yeah? This is a core principle of private equity. Yeah? You are only you're not a short-term investor, but you are also not a long-term investor. Yeah? Your investment horizon is something between 3 and 5 years usually, yeah, but definitely no longer than 10 years. Yeah, because all these funds have a limited lifetime. After 10 years, everything must be sold. Yeah, and of course they say we offer superior returns. Everybody wants to beat the market, and of course also them. Yeah, and then they say more about what they do. Yeah, basically say education, healthcare, data, digital, financial service. Yeah, so we have a broad set of industries. Yeah, but of course we have a focus on these industries. Yeah, they never would invest into mining or automotive or whatever, yeah? Because they say that's not our area of expertise. Yeah? And then they look for growth potential. Yeah? They buy a firm if they think we can grow the firm. Yeah? And this includes M&A, like you can grow a firm by internal investments or by simply buying another firm and merge them. Yeah, they seek management partnership. Yeah? They say we are not the corporate raiders of the United States. We are the friends of the management. Yeah? We want good management of these firms, and we want the management basically to be a partner. So they also become rich if everything is successful. Yeah? And if the management resists of doing so, well, the managers of course take a high risk, and they usually also invest in the companies, and they are part of the LBO. Yeah? So they usually have large amounts of debt, invest a large amount of money in the company, and then of course also have high-powered incentives. And if the manager says, no, I don't want this, then this is seen as a bad signal by the private equity fund. The manager seems to be pessimistic, he knows more than we do, so we better stay out. So they only invest when they find a management that they trust, and that is willing to also take a large risk, and then has the chance of becoming rich after the exit. So the manager for 5 years has to work extremely hard, but then after the exit, maybe a rich person. Yeah, a must-have service or product simply means they look for stable demand. Yeah, the best thing is non-cyclical industries, where people buy everything. Yeah? Bottled water is one example. Yeah? Everybody drinks. So there is no risk of a recession. Yeah? Because if you have to sell after 5 years, you don't want to be hit by a recession. And therefore they look at stable industries. And of course they only look at performing businesses. They say we are not turnaround managers. If somebody makes losses and really needs experts to basically restructure the whole company, that's not our business. It must be performing, and it's profitable, and it must be in a stable, growing market. So every fund basically has its investment objectives, and when you come with a good example, and it fits into it, they say, yeah, that fits to us, we do the investment, otherwise this is not a company for us. Yeah, and now we go to the next one. Altor is another private equity fund, quite similar, but when you go to the slides, they basically present themselves a little bit different. I jump over these three. No, let's look at this. This is really interesting. Aim high. So we are extremely ambitious in terms of making money. We are brave, bold. So we are the heroes. but we are also nice. Yeah? And we are team players. Yeah? And we act responsibility. Yeah, we would never basically cut down security of the bridges or be bad to society. Yeah? That is basically their core beliefs. And
it's kind of contradict itself.
Sorry?
So the 5 values at the core for this company, for this private equity fund, is kind of contradicts itself. Praise and hope, be nice.
Yeah.
Team always in that aim high.
It is very clear that private equity funds are not always nice. If the company has a problem, then that problem must be solved, and profit must be increased. But at least they try to be nice. Of course, if you're a private equity fund, you want to convince the management that they basically partner with you. And that they believe in this. And if you have a reputation to be like an Elon Musk, nobody wants to partner with you. So you must be strong and high-powered and ambitious, but at the same time you must be a good team player. Yeah, and they tell us a little bit more about who actually gives them the money. Yeah, private equity managers are rich people at the end of their life. And then they also become investors, but when they start, they are poor people. And therefore they need other people's money, so they go to asset managers. For example, there was BlackRock, but there was also Blackstone. BlackRock and Blackstone used to be one company. Blackstone was the largest private equity firm in the world. BlackRock has become the largest fund company, or ETF fund company of the world. There used to be one, and Blackstone, of course, invests into all kinds of things. So this is an asset manager who may decide where we give a part of our money to this company. Or there are rich families, like the Regal family, maybe at some point of time they decide to sell Haribo, because they realize they can't run it as a family firm anymore. Then they have lots of money, and they can invest it in the stock market. But many rich families basically invest in the private equity market simply because they believe that this is more profitable. Pension funds are very important. Do you know what SWF stands for? Something that you must know, but even German students quite often do know. It's a name for Sovereign Wealth Fund. So in the Middle East, Kuwait and the Arabic countries, they have rich kings, and they basically invest the money. And increasingly important. And then finance and insurance. Insurance companies have huge amounts of money, and they also allocate a part to private equity. So basically, this is all institutional money. There is no single person in it. The families, you may say this is individual, but they are so rich that they basically have a professional management team to invest their money. So you only talk to professionals and basically try to convince them, please give the money to this private equity fund, because we hope to make a lot of money from this. And they come to a large part from US and Canada. They are focused on Europe, but private equity is in American, not the biggest investors of the world, are simply sitting in the United States. That's where the richest families are, but that's also where the stock market and investment simply plays the biggest role. And one very simple reason, by the way, is the pension system. I get pension until I get paid by the government until the end of my life, and I get a small salary when I'm working, because a large part of my salary comes when I'm retired. I don't invest any money for my retirement savings, because I'm paid by the government. An American professor is paid only his salary, and he will take away 20% of his salary to invest in the stock market or in the private equity market, yeah, in order to have something to live on when he is retired. Yeah, so in America, everybody does this, and billions of money simply are the savings for retirement. Yeah, and these savings do not exist in Germany, yeah, because most people are paid like me. Yeah, so yeah, the dominant role of the United States in the stock market and also in the private equity market, to a large part, comes from the way how these nations organize their pension system. A pension system like Germany basically means there is not much money here. Yeah, pension funds in Germany basically do not exist. Yeah, yeah, and then of course, yeah, then they also focus on Northern Europe. Yeah, so this is Scandinavia, the Nordic countries, and the German-speaking countries, and UK, and then yeah, they also have 1% from Asia, but of course that doesn't pay a big role. Okay, they also basically have their focuses: business service, consumer, financial service, industrial, and tech. Yeah, so they say, yeah, we don't invest into everything, yeah, but quite broadly diversified. And the idea is, of course, that private equity managers would suffer a lot. But suppose they invest only in financial services, yeah, and suppose the financial service industry has a crash, yeah, like the financial breakdown of 2008. And then, of course, these people all go out bankrupt. Yeah? So these people have a lot of reason to diversify. If they don't diversify, they run a very high risk. Yeah? They have huge debts, financed with debt, yeah? and they can't afford a large risk. And therefore, they try to specialize and say we are experts in consumer or financial services, but at the same time, they try to reduce risk. Yeah? And that's why only stable companies, diversified industries, and so forth. Yeah, and now we come to this thing. Yeah. But initially, of course, yeah, they raise the money. Oops. The life of a fund is very easy. The PE fund lifetime basically has fundraising in the beginning. And you go out to the investors and basically say, we set up a new fund that starts at zero, please invest your money. Yeah? And then at some point of time, it is over. Yeah? And they say that they close the fund. Yeah? We have collected $1 or $2 billion, yeah? And now let's start investing. Yeah? So then we have the investment phase. Yeah? And this is 1 to 2 years. Yeah? This may be another 2 to 3 years. Yeah, they invest the money, and then of course they divest. Yeah, and this is, let's do it differently. Let's say what are the years. So this is year 1 to 2, this is year 3 to 4, and these are years 5 to 10. Yeah? And then, basically, this is the closing date. Yeah? In the contract, it says after 10 years, this fund will be closed. Yeah? And all the investors get their money back, yeah, with profits or non-profits. And then, if they are successful, yeah, this may be the fund number 1. And then they open the next fund, fund number 2, yeah, when they close this fund. Yeah? And then the next fund will start here, and the next fund will start here. Yeah? So a private equity company runs more than one fund, yeah? And when they start with 0, yeah? And they say, we are the first, yeah? we open our first fund, please invest. Yeah? That's of course very difficult to attract money. Yeah? After you have been in the market for many years, you can show all the results, yeah? And you show, look, we have already closed 3 of our funds, yeah? the earliest funds, and we did enormous returns for our shareholders. Yeah, please trust us that we can repeat this because we are such a great team. Yeah, and then what is very important, so that yeah, the so-called track record is basically the historical performance of these funds. And if you're old enough, you can basically say, look, this fund here for an IRR of maybe 30%. Yeah? And this is the reason why they closed the fund after 10 years. Yeah? Then basically the cash is on the table. IRR is the internal rate of return. Yeah? They basically achieved a high profit for the shareholders. Yeah? And the most successful and old established funds basically have been closing many funds already. Yeah? And then the track record basically says, yeah, the first fund did 30%, the second fund was even more successful and returned 50%. Yeah, then the third fund was a bit weaker, but still 25%. Yeah, and that is also very attractive to shareholders. Yeah, then they can easily go to the institutional investors and collect money. Yeah. So now we are here, and we start investing. Yeah, and the investment team of the fund basically looks, what can we do? And the first thing is they go to M&A advisors. Yeah, they go to Citigroup and say, we are interested in buying something. Yeah. What would you recommend? Yeah, and then Citigroup says, oh, one of our customers is Conti, and Conti is interested in, or may be interested in selling the automotive sector. Yeah, and then basically this is one start. Yeah. Let's go here. Screening of public situations for relative undervaluations. Yeah? They basically look into the press, yeah? They look at analyst reports, and then they read something. Continental is undervalued because they suffer from a conglomerate discount. Yeah? And then they may directly approach Continental and discuss about this undervaluation, and basically said, wouldn't it be a good idea that we buy a part of the company, and then the rest is basically better off. Yeah, full processes I think is just a name of, yeah, there was somebody like the Haribo family, and they basically call them and say, yeah, we are a family firm and we want to sell. Yeah, please talk to us. Yeah, and then bilateral discussion basically means, yeah, this is the ideal case. Sorry. This is a bilateral situation. And of course, you can also have the following situation, that the seller is talking to many, PE1, PE2, and so forth. Now, what every PE fund dreams of is that I have exclusive contact to, for example, the Haribo family. Yeah? There was no competition from other funds, and this is not an auction process where only the biggest wins. Yeah? So they prefer to have bilateral conversations and to keep out the competition as long as possible. So this is this. Yeah. Then they also look at other private equity funds, and they basically then look for secondaries. Yeah. They say private equity fund is in this situation right here. They soon will have to sell. Yeah. And yeah, they look at smaller funds because every private equity fund grows the firm. Yeah, and now it is the small funds buy small firms, the medium-sized funds buy medium-sized firms, the large private equity funds buy the large firms. After 3 years, the firm will have been growing, and now it is basically the right time for a mid-sized private equity fund like this one to buy it. Yeah, and hopefully then, this origination, basically the sourcing of deal, hopefully you have as much as 1,300 basically ideas or proposals where you could invest. and they claim that they have this every year. Yeah? So some people in the fund basically only screen all these proposals. Yeah? Citigroup just sends them one letter. Yeah? Haribo wants to sell. It's whatever kind of business segment, yeah, would you be interested in? Yeah? And then you screen out and basically you select 240 of them where you decide to have meetings with the management team. Yeah? And that basically the fund says 240 times we will just meet the management team of enterprises or of parts of enterprises that will be bought out. And yeah, they say 500 plus relationships are actively tracked, so we are in close contact to 500 companies, and maybe sooner or later, yeah, this may become an investment for us. Yeah. And then basically they start 40 times a year, we actually start an investment project. Yeah, so somebody really is serious about selling, yeah, and he invited us, or they invited a number of private equity funds, basically to really do a due diligence, yeah, to investigate everything, to do the valuation, like you did on Continental, and then basically to put an offer price on the table. And of course, deals one, yeah, is the winning. Yeah. You really fight for deals, and if you get the investment done, then you have been the winner. And in the easiest case, of course, you were just offering the highest price. Yeah, but these private equity companies, of course, believe that it's much more than price. And you also need trust, and you need confidence in the abilities. Yeah, so if you have a great team, a great track record, yeah, you may actually get the deal at a lower price as competitors, yeah, simply because people trust you. Yeah, and therefore, winning the deal is a great success of the private equity companies. But of course, this then only starts. Yeah, and then of course this fund says, yeah, we are the heroes. Yeah, we have great outcomes. And what are they most proud about? Yeah, they said the majority of our deals we exit in less than 3 years. Yeah, so one thing is very clear: you want to make profit, but the best profit is in a short period of time. Yeah, because that's what our investors really love. Yeah, and then we can make more deals. Yeah, we can show more often how great we are. Yeah, so the holding period is very much important. Yeah, 5 years on average, as I say. Yeah, and this bilateral process, yeah, when the seller is a private equity company, yeah, a professional company, they will try to make an auction. Yeah, if this is Citigroup, yeah, a professional investment bank, they will also try to make an auction. Yeah, and the more competition you have, yeah, the less likely is it that you get an attractive price. Yeah, so the best thing is to have a bilateral situation where you are enjoying a kind of monopoly position. Yeah? In the best case, yeah, you simply know the family who is selling. Yeah, the family trusts you because you are so nice. You convince them that you make a serious offer, yeah, that they don't buy too cheap, yeah, and then you get the deal without this competition. Yeah? And they say, this is the case in the majority of our cases, yeah? And they are very proud of this. Yeah. And then the last thing is, yeah, if you are in that kind of situation, what is the management preference? Of course, ultimately, the support by the management, the willingness of the management basically to co-invest is a precondition. Yeah? Otherwise, many of these PE deals do not take place. Yeah? But the ultimate decision maker is, of course, the owner. Yeah? It's just the Haribo family who decides to sell their business. Yeah? And if they have a professional manager hired, yeah, then this manager decides, do I most like this fund or do I most like this fund? Yeah? And if this fund is the winner, am I willing to invest my own money into the company because I trust this fund? Yeah? Or do I not? Yeah? And if you are the management preferred bidder, yeah, then of course you are liked by managers, yeah, they trust you, and they believe that partnering with this private equity fund is the best thing. Yeah? So it's interesting because usually, but other funds basically show only this. Yeah? When you go to investors, you show this. Yeah, dear investor, we made a lot of money for you. Yeah? But if you go to the companies, you show this. Yeah, we are smart and nice people. Yeah, we are team players. Yeah, and we are successful in these areas. By the way, if the manager is important, suppose you are a manager and you really have to invest all your money into this firm, and then of course, the quicker you get out, the smaller the risk is. The manager may say, I have a family, I want to build an own house, but I first bought my own company, so as long as I have invested all my wealth here, I can't buy an own house. But if I exit after 3 years already, then my children will grow up in a nice villa with swimming pool. And so the time to exit is also important for the managers. And I just talked to a very successful manager last week, and he basically told me, I had a family, I had a wife, and the wife told me, you are a private equity manager, you must be rich, why can't we have an own house? And she said, sorry, you have to wait, because I have to, the amount of loans that I can get from a bank, I must invest all the money into the companies. I don't have money for private purposes. So for a long time, the people are already rich, but they still don't have an own house. And if they retire, then of course they drive a Porsche or a Ferrari, and they have 3 houses, and can enjoy a nice lifetime if they have been successful at first. Now Montagu basically also tells us that they are experts in carve-outs. So carve-out is basically meaning that if you look at Siemens, and if you look at all those companies, and there are many, many different segments, the carve-out basically means this is going out to a private equity company. Carving out in the pure sense is to dig out something, but basically it's a part of a company. And a company like Siemens every year sells lots of business segments. And that's where they focus on. So they usually don't go to families like Haribo, and they don't buy a whole firm. They buy a small part of Siemens, where Siemens says, this is no longer our core competencies. We don't want to manage this anymore. And then they basically say, in these carve-outs, what we are really proud of is the entry and the exit multiple. And from your continued valuation, you know what this is. Private equity funds basically never say, we bought this company for 40 million or 40 billion. We said, we bought this company for 9 times EBITDA. And they don't even tell you what the multiple is. And you simply have to know that when private equity companies talk about multiples, they mean the EBITDA multiple. And so they have been buying at 9 times EBITDA, they have been selling for 13 times EBITDA. If EBITDA is unchanged, that would mean that they roughly make 40%. But of course, don't forget that they grow the company, so the EBITDA is growing between entry and exit, and they use a lot of leverage. And the leverage amplifies the equity returns. So if this is true, that sounds extremely profitable. And they say there is much in the pipeline. Many companies like Siemens plan to sell parts of the companies, and therefore we have lots of investment opportunities. And they show a number of examples. And then they show basically, well, since they specialize in the carve-out market, they basically show how this carve-out market evolved over the last 40 years. So on average, something like 15% of all buyout deals were carve-outs. So when enterprises or parts of enterprises were taken over in a leveraged buyout or in a management buyout, this fraction was coming from carve-outs, and then they basically have this projection and say, EY, that is Ernst Young, basically predict a large increase, and therefore of course, we expect great opportunities in the future. And then they say, yeah, last year, Montagu basically invested 600 million in these 3 carve-outs. I don't know where they actually come from, but these are all parts of larger corporations that basically have been separated as an individual corporation now. They used to be a part of Siemens, now they are a standalone company. And if you think that, well, on average, there was 200 billion for each company, and as a rough estimate, 1% comes from the management. So the management team of each of these companies basically has 1 million of debt in order to do this. The partners of the private equity firm may have another 1%, so they also have 1 million of debt. Maybe it's a team of 5 people. Everybody then has $200,000 in debt, and the rest, 98%, comes from the investors. And the investors basically say, I only invest my money when the management and when also the private equity team members co-invest. If they don't invest their own money, after knowing everything, after having looked at the details, this is basically a very, very important signal of confidence for the pension funds and for the other investors, basically to put their money in this company. And then they start with a case study and basically start. Structured process, of course, means we are not like Elon Musk or like Warren Buffett, who basically thinks a lot and then says, I buy this or I buy that. That seems a bit arbitrary. They say we are very professional in basically analyzing the companies and selecting the best ones. And of course, one part of it was shown here. This is basically how they organize this pipeline of investment proposals, and then they talk about more how this works. And of course, regular, this is an auction process. When Siemens sells something like this, they will never only talk to one private equity fund. They will always hire somebody like Citigroup. The Citigroup basically does a valuation, very much like you did, and writes all the results down and sends this to many private equity funds and also to other corporations. And they also think about, could this be an IPO? Could we sell this to the stock market? The task is value that firm, provide all the information necessary for investors, and then find the best investor. And in the end, of course, Siemens wants the highest price, so they establish a kind of auction process. And then, basically in the beginning it's just chat, that's basically gossip. So you have this private equity fund basically on a weekly basis calls with the Citigroup and say, what are the news? And then people would say, we just saw that Conti may have an undervaluation problem. Maybe something comes, but no decision has yet been made. But then the private equity funds basically can prepare and get knowledge in this particular area. Then a teaser is nothing else than a one-page document. Siemens thinks about carving out the healthcare industry, for example. This year they want to carve out Healthineers, their healthcare business. And you send this to a large amount of people. So this is now in the press. Everybody knows Siemens tries to sell something, and thousands of people, basically, where everybody gets to know this. And then only here it becomes multilateral. Then Citigroup prepares something like 5 or 10 pages, called an investment memorandum, summarizing the results. Basically, just what you saw. What we saw in Citigroup. This kind of the most important information for investors, and they sell this to a selected group of people that they believe may be interested. And then you have indicative non-binding bids. basically all the investors, the potential investors, are asked to do their own valuation and basically think what they could imagine to be their willingness to pay. And only the 5 best bids are then selected. Around 5 parties remain. The last phase, if you think about what is the optimal amount here, and here it starts with PE, with number 5. 5 is enough to have good competition, but more than 5 is just, first of all, too much time, too much effort, but importantly, the probability of winning is too small. If you are a private equity fund and you have to invest a large amount of money and of time to this process, and if your chances of winning is only 10%, you may say, no, I'm not interested. So only 5 basically are in the last round, and they get access to the data room. So the company has lots of highly secret, confidential information, but of course important for the buyer. So they get access to it. Of course, they have to sign a confidentiality agreement. They must not pass this over to somebody else. And they start negotiations on SPA. This is the sale and purchase agreement. That's basically the contract to buy the whole thing. It's a long contract, obviously. The buyer will say, I buy this, but only if certain conditions are met. And then these are quite long contracts. And there was much more than the price that is mentioned in the contracts. And there was quite a lot of negotiation going on. And then, of course, when these SPAs are done, and when the bids are on the table, then the last thing is the signing. So Siemens decides, Montagu is the best offer. They may not offer the best price, but the overall package is most convincing. So we sign the contract with them. That is the process. And and after signing, lots of bottles of champagne are opened, because this is really an extremely time-consuming process. And of course, most, 80% of the PE funds are losers. On average, if you have 5 bidders, 5 PE funds competing, only one basically gets the deal done. And and the others do not. And of course, you may think, do I want to be the winner or do I want to be the loser? There is something called a very important buzzword. It's called the winner's curse. Please Google for this and see what it is. If you are competing in an auction, some people are too pessimistic, some people are too optimistic. On average, people may be right, but there are always people that are too optimistic and too pessimistic. And winner's curse basically means if you are too optimistic and you bid too much, then you will become the winner. Once you know that you are the winner, you know, oh, I have been too optimistic. I paid too much. So in auctions, there is often the phenomenon that the people overpay. Simply because competition and information asymmetries basically result in a winner's curse. And there was a lot of evidence that this happens in many industries, but the PE industry is of course very professional. So usually they open the champagne bottles and they say, we made a good deal. We do not pay too much. And it's interesting to see what kind of things happen in this process. So we talk about what happens in this period of time here, when 5 PE funds basically have to do something. And what you see here is, this is Altor, this is the private equity fund. And they work continuously on everything, and then they have some meetings and then sign the transaction. But all the rest is, there is Well, I started here. There was the commercial track, and here is Bain. Yeah, Bain is the company, a consulting company, paid by Altra in order to do the commercial due diligence. Yeah, so they look at the company and basically look at their growth potential, at their stability, yeah, their whatever. Yeah. The next one is financial, EY in this case. Yeah, so you pay EY, Ernst & Young, in order to look deeply into the financial reports and see, for example, are all the numbers okay? Is there fraud in the balance sheet? Is there some risks detected in the balance sheet? And can we really rely on these numbers? Yeah. And there was another tax due diligence, also by Ernst & Young. So you pay Ernst & Young to look in detail at all the tax bills and find out whether the company always paid the taxes and whether everything is okay. And the last is legal. Milbank as a large law firm, and they basically look at many legal aspects. So, and they all have to do a lot of things, yeah, and that takes roughly 1 month. So that basically tells us that these kinds of transactions basically give work not only to the private equity company, yeah, but mainly to consulting companies like Bain, yeah, to due diligence companies like Ernst & Young that basically check the numbers, yeah, to law firms like LinkedIn, so the good bank here. So many people make a lot of money from working on these transactions. Of course, most people would dream to work here, but many are working elsewhere. Yeah? And the last thing is the lending thing. Of course, you have to meet with the banks and with the bankers in order to finance all this. And you can only buy this if you have, well, you plan with a certain degree of leverage, quite often quite aggressive leverage. So you talk to the banks and say, yeah, in this case, we believe it's very safe, it's very stable, yeah, so how much debt would the bank offer, yeah, and how much would this cost? Yeah, so these are basically the main areas of work that the people have to spend. And if you are surprised that the private equity funds are so small, the reason is that they do not engage in all these kinds of things. Yeah? They basically outsource many of the things. Yeah? They hire Bain and Ernst & Young and other firms to basically do the analysis. And one reason is that suppose a private equity fund manager would do it himself. If you are a private equity fund manager, basically you are paid for, well, you have been analyzing so many transactions, and your target is to bring that through, and to convince your colleagues to invest in that company. And of course you are biased, you are too optimistic by nature. And therefore nobody believes you. They only believe in neutral advice. Simply because private equity managers make their money from convincing other people to invest. They prepare the proposal, they present the results, and they say this is attractive. I selected this as the most attractive investment. Dear partners, do you agree? And do we invest all our money there? And in that kind of situation, he says, Bain said this, and Ernst & Young said this, it all looks good. This is basically the information situation. And that's why they basically outsource almost everything, and concentrate only on reading the management, like here, reading the bankers, like here, and analyzing, of course, reading all the results and analyzing the results. By the way, you can also start in private equity, but be unsuccessful. One of my close friends, after 20 years at McKinsey and a long and very successful career, started with one of these private equity funds, and he found many good investment opportunities, like this one. He presented them to the management board. He did not get accepted any of them. So basically he left the firm without having made any investment. He didn't have a track record. People did not know him. People did not trust him. Maybe he did not have the right abilities. In the end, he was earning just a small base salary. And if you don't get your investment proposals through, basically, yeah, you have to go. Yeah, they don't even have to fire you. You just realize you are lost. Yeah, you are not trustworthy enough. Yeah. So working as a private equity manager to a large part means convincing your other colleagues to do the investment. Yeah, given that you have to put 1 million of own money into each deal. Yeah, so this is what high-powered incentives in this industry are. And there is competition. Yeah, there are many private equity managers. Yeah, they bring different deals, and only the best deals basically are approved by the majority of the fund management team.
I think the whole financial services industry is built upon trust and reputation.
Yeah, it's trust, and you trust more the people that you know. Yeah? And you trust more the people that have a track record. Yeah, but you also trust in incentive devices. Yeah. Yeah, the pension fund only invests its money because they know that the management team and the private equity investors also invested their own money. Yeah, so signaling and creating the right incentives is the second part that I believe is very important. Yeah, and now you also realize why you need a lot of experience to become a private equity manager. Yeah? Even after 20 years of McKinsey, there was not enough basically to convince the people. Yeah? So if you start there as a university graduate, all you can do is do some analysis. Yeah? But that's usually done by Ernst & Young or by Bain. Yeah? So they basically tell you, why not start at Ernst & Young, learn in the due diligence. Yeah? You can work on private equity deals, you can see how they work, and then maybe 10 years later, you could knock on our door and maybe become a private equity manager. Yeah, and now we really go to one specific company. Yeah, VTU is basically an engineering solution provider. That doesn't mean nothing else. They build machines and they sell this to the life science. Yeah, that's basically the healthcare industry. Yeah, so. Yeah, and it's an Austrian firm. Yeah, they are located here in this country, south of Germany, and they have 1,200 full-time employees, and that is almost all engineers and consultants. And so very, very clear business model. Yeah, only machines mainly to produce drugs. Yeah, so they work for the pharmaceutical industry mainly. Yeah, life science is just a buzzword for many things, but the largest part of life science is the pharmaceutical industry. Yeah, and they basically build machines for all kinds of pharmaceuticals. Yeah, so let's look first of all here. These are the largest pharmaceutical companies in Europe, and that's where they. That's their customers, and they sell to large firms that produce pharmaceuticals, and basically they say it is nice that this company sells in 4 different countries. That looks a bit like diversification, so you don't depend on your one country. I don't know what this actually means. Yeah, there are different business segments. Basically, repeat basically means the company has developed a new pharmacy, it ordered the first machine, the product is successful, and then now they need a second and a third machine. And new, brand new, so the first machine ever is only a small part. Yeah? So that sounds like rather stable. They have mainly life science companies, and these are the big pharmaceutical firms. And you know this is very cyclical. Yeah? People are very uncyclical, very stable. Yeah? People always get ill. Yeah? They always need drugs, and drugs always need machines to produce them. Yeah? And this company provides these machines. And they have a large number of projects, 2,800. So that's basically the number of machines, and they make a lot of profit from small, medium-sized, and from large projects. And the most important thing is here on the right-hand side. T&M stands for time and material. And this relates to the contract that they have. Yeah? Suppose the pharmaceutical firm wants to have a specialized machine that is able to produce a specialized kind of drug. Yeah? Then they can either say, I pay you 1 million as a fixed price. Yeah? And if it takes more than 1 million to produce this machine, that's your risk. Yeah? Time and machine, time and material basically means all the risk is with the customer. Yeah? This construction company basically says, yeah, I have to buy the material for this machine, and I have to invest the time of my engineers, and if we need more engineers than expected, or if we need more materials than expected, you have to pay it. Yeah? So all the risk is with these customers. Yeah? And this is important. Well, this is an original slide from their investment committee. And this is how they convince the other private equity managers that this is a good investment. And risk is, of course, very important. Yeah? So this all points towards low risk for the company and therefore stable profits. And then, of course, they want to show growth. Yeah? And basically, they look at the life sciences CapEx. Yeah? So CapEx is capital expenditure. And capital expenditure means new machines. If you sell these new machines, yeah, this is your growth. Yeah? And they basically say, look, it has been growing always. It's actually increasing in growth. Yeah? And the outlook is quite positive. Yeah? So we can expect to grow the EBITDA or the free cash flow of that firm over the next years. Yeah? And then again, they basically show that a large part is new facilities or whatever. Yeah? In the end, they invest if they believe in growth of that industry and if they believe in low risk. This what we're doing sometimes. Yeah, so let's go. I think these are, yeah, I guess, but I'm not sure, but I guess that these are really slides that were used in reality in order to convince the other partners to invest. Yeah? Is this a good investment? Yeah? And you don't present all the nitty-gritty details. Yeah? You have them prepared in your drawer, and you can put all the data on. But in some ways, this is resilient, means stable. Life science is good, yeah, and 10%. Do you know what this is? CAGR is a very prominent word. It's cumulative. I think A is average, and growth rate. Yeah, it's always the growth rate. GR is the growth rate. Cumulative is basic. Yeah. So on average, this company grows at 10% every year. And it has a strong market position, and the customers are blue chip, very stable customers. They will not go bankrupt, and they will continue to order. It has strong relations and strong domain knowledge, so basically there is no competition. They will always buy from this firm, although they have this time and material kind of thing. This is very important. A de-risked operating model. Time and material basically says we bear no risk. If the company orders a new machine and it turns out that this machine is more expensive than expected, the company will have to pay more. And for the equity investor, of course, it is good because the customer bears the risk, not the company. Then 35% recurring smaller optimization projects. So it is diversified. Recurring means that they come one after the other, and this looks like very stable business. Like if you buy a car, you have to go to the repair station or to do an inspection once a year. And this is a recurring business. You are basically forced to do the maintenance, and of course, after selling, this kind of business is the most stable business. 90% of all profits from existing customers Yeah, so even these customers have been there for a long time. They stay customers, so they must be happy. Yeah? New customers, you never know how long they will stay there. Yeah? So basically all signs of stability. Yeah. And then they talk about value creation. Yeah. Ambitious value creation agenda. Well, of course, for the students, they don't show the precise numbers. Yeah. Of course, they also have slides with the numbers. Yeah. If the number would be if we buy at 10 times EBITDA, if we grow EBITDA by 50%, yeah, and if we can then sell at maybe 15 times EBITDA, that would return in a profits or rate of return that is fantastic. Yeah, this kind of slide that was missing here. You don't show it to the public, but it is ambitious. Yeah, so our profit potential is substantial. Yeah, and this is in German-speaking countries in a stable industry like life sciences. It is sustainable. Yeah, because people always need these kinds of machines, and we want to realize operational improvement levels. Yeah, we believe that the profitability can be improved. We have been investigating this. Yeah, Bain or Ernst & Young had made proposals, and we think maybe to cut the cost by 10% by firing some people or whatever to do. Yeah? So this is a summary. And then the last thing is there were attractive M&A potential. Yeah? So besides this firm, VTU, there were also similar other firms. If we would also buy them, combine them with VTU, yeah, we have an even larger firm, which we then can sell afterwards. So these are the main reasons summarized why this transaction looks really interesting. Yeah. And then of course they have lots of additional materials where they basically prove that everything is correct. Yeah? And this, for example, is they look at all the customers and ask Ernst & Young basically to do an analysis. Is that customer profitable? Is that customer growing? Is that customer happy with the machines they bought from this company? And they say, this bottom-up assessment, customer by customer, results in a good pipeline and resilience of the market. Yeah? Basically, these customers are likely to stay and even to order more. And I think no indication that CapEx programs are reduced or delayed. This is, of course, the most important thing. If a pharmaceutical company, a customer of them is under stress, they may cut down on CapEx because they need to save money, and basically they look company by company if there are any signs of this happening. And then of course you do you look at the key customers that are the most important, and you look at what is the share of wallet. So how many machines do they buy from our company? How many machines do they buy from other companies? And what's our potential there? That's what Bain was doing. So they had a group of Bain consultants basically to confirm the strong standing and that there was the potential to grow more. We don't know what Bain actually did, but maybe they just took the telephone and called these people and tried to ask. Bain has a large network. Maybe there was a Bain team in these customer teams, and just after people working for Bain within these companies, and then get access to this information. So besides basically only looking at the company, like we did at Continental, they also looked at the customers, because the company can only proceed and become more profitable if they have happy and healthy customers. And that seems to be the case. And then they basically say, look, well, there were no numbers, of course, only for the students. In reality, we would have numbers. This is how much we invest. This is how much we hope to receive after exit. Yeah, and these are the different reasons why we believe to make a lot of profit. And yeah, M&A is one part. Yeah, whatever optimization is, I don't know what they exactly mean. I tried to Google what is LS growth and TST growth, but even ChatGPT was not able to explain these terms for me, so we don't know. But this is basically their ultimate vision. Yeah? Building a European leader in high value and engineering services for the life science industry and for the green transition. Basically, they think that the green transition offers additional potential, and they believe that if you are the market leader, yeah, you are even stronger. And so, yeah, all these basically arguments, all these points here, basically are reasons why you can hopefully exit at a much higher value than the entry value. Yeah, I think we are almost done. Oh yeah, the last part is really now, I will go back here. Among 5 parties still in the race, how can you be the winner? Yeah? And they continue to say, who were the other people in the race? Yeah? And they say, look, these are our competitors. Yeah? They were all private equity funds, and they were all quite similar. Yeah? All these equity funds basically concentrate in similar regions. And yeah, and here was one fourth. Strategic. What does it mean? That is simply a competitor of the firm. A strategic buyer is another producer of machines, yeah, and he wants basically to merge. Yeah? This is like the Warner, the Time Warner case. Yeah? A strategic buyer is always a buyer that has own operations and similar operations. Yeah? So there was one of these in the game, but the 3 most important, or the 3 that you can openly talk about, yeah, were other private equity firms. And so, if you want to convince management, you basically have to convince them that you are better than those. And so you analyze your competitors closely, and you try to convince both the seller and the management that you are better. Yeah? And how do you do it? Yeah? You present your team. Yeah? You say, this is us. Yeah? Look how nice we are. Look how much experience we have, and all that kind of things. Yeah? And this was in the press actually. Merger Market is on Bloomberg, yeah? So everybody that has access to Bloomberg gets to read this. Yeah? And then they say, yeah, private equity buyers, PI partners, yeah, the competitor, and IK partners and other competitors are among the sponsors serious about placing final bids. Yeah? So they are in the last round of bidding, yeah, for the Australian engineering firm BTU. And then it says Altor, yeah, our firm, is also among the sponsors tipped to place final bids. Yeah, we actually invited, yeah, the seller, Siemens, or the M&A advisor, Citigroup. Yeah, they basically decide who is invited to be in the last round of bidding, yeah, with whom we really actively negotiate. Yeah, and then it said that PI is actually pretty for a strong offer. Somebody said, yeah, so there are rumors that they are very aggressive. Yeah, they seem to bid a high price. Yeah, but then it was Altor, yeah, who got the winning bid placed. Yeah, so that was victory, and of course we don't know why they were winning this bid. Yeah, but probably because the overall package was the best one. Yeah, and remember, it is not always the highest price that wins. Yeah, it is sometimes, yeah, you have to look at the whole contract in order to see what kind of, if the company basically says, I pay a high price, but should the profit next year go down, then I get X a part of the price. Yeah, these are kind of guarantees. Yeah, they can easily be used to offer on face a high price, but of course the overall offer is not interesting. So it is more than price that basically makes the attractiveness of the offer, and whoever is the seller must evaluate these 3 or 5 offers, and then basically they want this. I think we should stop here. There were some more slides on exits, but I think this is a bit too much. Basically we are now here, we saw how you win the investment, and then of course comes full private equity is basically we're here, and you have to learn how to make this a successful company. And of course the last step is how to sell this, how to set up the selling process. But of course it's a large part the same than the investment process. Now you are like Siemens, you hire Citigroup in order to prepare an investment memorandum, you prepare them to ask for interested parties and so forth. And the thing that is really most puzzling in Germany is, all over the world, why do we have so many secondary buyouts today? When the private equity industry started, we thought, okay, there is a large company like Siemens, and they are not effective in managing this. It's not their core experience. They are focused on other things. Or there are companies like Time that will run inefficiently, and then the private equity firm basically has the better management team or the better incentive system. So if you believe that there are many good reasons why private equity is a better governance model, in the end, private equity is just a governance model that seemingly results in high returns, and that seemingly is capable of generating shareholder value. And if you believe that private equity adds something, then after 5 years, this is added. Whatever private equity can add has been added. So why is then a second private equity fund again buying this and try to add something more? And now we have already many tertiary private equity funds. So 2 equity funds actually did everything to basically improve the profitability, to improve the value as much as possible, and the 3rd fund starts to do the same thing. And many people basically think this doesn't make any sense. Maybe it is wrong to basically say after 5 years we need to go out. Initially the private equity fund basically said we want to move out soon because we want to build a track record. We want to show to our investors, look how great we are. But they are great now. They have a track record. So it's no longer needed to create this track record. And my perspective is that in the future there will be more private equity funds that basically say, we hold this for 10 or 15 years. The returns will be a bit smaller, but in the end the investors want to invest the money anytime. Investors, the pension fund doesn't want the money back. They want to keep the money invested. And this whole M&A process, of course, selling and buying companies, means a lot of people from Bain, from Ernst & Young, from the law firms must engage here. It is huge transaction costs. And therefore, it's like corporate takeovers. Corporate takeovers is a costly mechanism to make things better, hopefully. And private equity transactions are also very costly. Therefore, it remains to be seen what the future is. But given that so much more money is running into the private equity market compared to the public equity market, one thing is clear, the stock market has a problem. And many people say the stock market has a problem because sometimes you have people like Elon Musk who are just crazy and we don't want to co-invest with them. Or we have stocks like Siemens or Daimler-Benz, where we suffer from all the problems, the governance problems of public corporations that we discussed in the morning. And then private equity may be the better model. But then why do you have to buy and sell every 5 years? That doesn't seem to make sense. If private equity is better than public equity, why does private equity is not available on a longer term basis? Currently, it's all the investment funds basically say after 10 years, you investor, you get your money back. Yeah? And it's almost a requirement in order to get money. Yeah? People would not put the money on the table there because it requires too much trust. Yeah? If you get your money back, then you can see, you can evaluate, and you can decide yourself, yeah, whether to invest in the next fund or not. Yeah? So the very fact that the lifetime is limited is basically a signal of distrust. Yeah? But now that these management teams, they started with zero 50 years ago, yeah? And it was clear that they were not trusted a lot. Yeah? But now they are the heroes, yeah? And maybe they don't have to have this limited lifetime anymore. Yeah, so fascinating industry. And if you're in Frankfurt, you also have access to Preqin. Yeah, Preqin is the main database used. It costs a lot of money. Yeah, so only a few universities in the world basically pay the money to get the data. Yeah, and if you want to do research about this, well, first of all, I'm not 100% sure what I think, but we bought this a couple of years ago. But you have to pay every year. Our private equity professor left the university, so maybe we are not paying anymore. But at least the old data, yeah, must be there. And and if you write your master thesis, basically, you have to think about what kind of data can I use. And you know that at least some people are always in Germany. Yeah, so the VGU students in Germany that have access to the House of Finance data room, they can basically download. Yeah, and if you read academic articles and you read that they use only Preqin data, yeah, and you know, and you just check, yeah, whether you also can get Preqin data, maybe a bit illegal, but yeah, only Frankfurt students have the right basically to download the data, but we don't care so much if this data is shared among others. Yeah, then you know what kind of research you can do yourself. And I recommend, yeah, research in finance is to a large extent dictated by what is your data access. And if you have weak data, your analysis is weak. If you are a student at other German universities that don't have Preqin, you can't do private equity research. Yeah? Many people would like to, but if you don't, if you have only weak data, it doesn't make sense. Yeah? So, yeah, I really encourage you basically to think what kind of data is available. There is something called the House of Finance. House of Finance has this abbreviation, so this is the House of Finance. It's basically the building where my office is and where all the finance professors sit. And then we have a data room. And this data room is, of course, on the internet. Yeah, so you can look on the internet what kind of data we have. Yeah, and then you know, and if you have some VGU student in Frankfurt who invests a lot of time in order to go through the database, and you can convince him or her to download the data, and then you can make use of the data. Yeah, and that would be the starting point of an empirical master thesis in this area. Okay, well, now we are right at 12 o'clock at the end of this long course. Yeah, so thanks for your attendance. I really like the high level of energy. I know it is very difficult to listen for such long hours, and I know that if you are not so fluent in English, it's even more tiring. And I really appreciate a lot that you invested a lot of effort and time for this. I hope you enjoyed the class, and I wish you, I cross my fingers for your final exam. Thanks a lot.
This is the most amazing lecture I heard about private